Hi, this is Jim Harvey, president of Opus 111 Group, and it's January in 2024, and I thought it would make sense to, think about the upcoming election season, which of course nobody looks forward to, especially in today's sort of contentious political environment and all of those aggravating and misleading political ads that we all have to watch on television. But I thought I would take just a couple seconds to talk about, do elections really have any effect on the markets? And then based on that, what can we expect with, in terms of market and economic impacts moving forward for 2024? So basically what we have found in all of our research is that elections have very little impact on the long-term performance of the market. And so it really doesn't make a lot of sense to, make a decision. As difficult as it is emotionally, if you feel, depending on which side of the aisle you are, is like, oh my God, the world's going to end because, Donald Trump or Joe Biden does or does not get elected. The fact is that it really has very little effect on the market, maybe a little bit more on the economy, depending on policy, but not on the market. So this is a chart that goes all the way back to Herbert Hoover, and what you'll see is, these are all the positive years, and here are all the negative years. And we do have the rule of 55, 65, and 75, and the data absolutely supports that almost to the T. That rule basically says that the market is up 55% of all trading days. There are 252 of those every year. 65% of all trading months and 75% of all trading years. And so as you can see, first, the number of years positive of zero right here is far greater than the negatives. But the other question is, well, what's the average return over the first year of a president's term, the second, the third, and the fourth? And so the first year average is 9.88, the second year 847, the third year is 1764, which might lead you to think that maybe they're governing, who knows? And then the fourth year is 10%. Again, as I mentioned, the rule of 75, in 67 of the 92 years in this chart that goes all the way back to 1929, there were positive returns. The 4-year average return over the term of each president has been about 46%. And for Republicans, it's been 7.85%, and for Democrats, 14.93%. So what do we make of all this? Well, this chart really kind of takes it, to the max. What you'll see here is if you stayed fully invested, this is the return you would get. So 10,000 would grow to, I'll call it 3.2 million. However, if all you did is bought during Republican administrations, your 10,000 would grow to maybe 40 or 50,000. If you bought just during Democrats, it would be maybe 10,000 going to 300,000. But the point is, it's folly to make decisions about what you're going to do with your money based on who's in the White House or who isn't. The most important thing is to have a good overall plan and stick to it and invest for the long term. Okay, so if in fact the data is clear that political factors in the terms of who gets into the White House has no material impact on your returns, then what are we looking at this year? So what are the economic factors? Okay, so the first thing to bear in mind, this chart talks about M2, which is money supplied, versus consumer price index, which is a measure of inflation. And as you can see, going back to 1960, the two were, roughly in the same bandwidth, except when COVID hit. When COVID hit, M2 just exploded because the Fed was printing money to shore up the economy. And I think they did what they had to do. But it also then came way down. And as you can see, inflation, which is this orange line, went up quite a bit. It went, because it had been averaging about 2% over the last 30 years. But then it went up to almost 9%, and then it's dropped back down. Right now, as of January 11th of this year, the year-over-year inflation was 3.4%, which is still higher than what the Fed's target is at 2%. But I think that's really going to be the new equilibrium for inflation, somewhere between 3 and 3.5%. And quite frankly, when I first got into the business, as you can see here in 1983, it was sort of in that zip code for a while. And then after the credit crisis, you see it came down to a negative. And that was because we had the credit crisis, and since it's been very low. All right, so that's that. Where do interest rates go from here? This is the actual versus the implied rate of the Fed funds. Don't forget that the Fed funds rate is the rate at which member banks can borrow from the Fed. And so, as you can see, each one of these notches here represents a Fed hike. So that it did hike up during the 04-05 range, and then we had the credit crisis, and it dropped way down to flat, almost a 0.25%. And it went back up, and then it came way back down right when COVID hit. And these gray areas represent the recession. So, right now, what you now see is it got hiked up. This hike that we've experienced over the last year or two with under Chairman Powell is the biggest in Fed history, and it went up 500 from 0.25% to 5.50, 5.75. Now you'll see that it's now starting to tail off, and we've had interest rates start to drop, but it still hasn't really affected things yet. This is unemployment rate and recession risk. And so, the push-pull challenge for the Fed is they want to have a growing economy, but they need to keep inflation down and unemployment down. And so when you look over this period of time, going back to 1966, the current understanding is that full employment is anything less than 4. However, when I got into the business in the 80s, the answer was anything less than 5. So that number changes about what's considered full employment. But what you'll notice here is in each one of these gray areas, which again represents recessions, the unemployment rate spikes quite a bit. And then we had the COVID thing, and it spiked way up, and now it's back down. So the question is, where are we? And are we likely to see a recession? Well, I'd be more worried about a recession if unemployment was spiking up. And, just this week, there were layoffs announced by companies like Microsoft, eBay, SAP, Citigroup is laying off 20,000 employees. I think companies are looking at what's going on and thinking, hey, you know what? This might be a good time to tighten our belts and make some more profits. But that's the situation there. So while I think a recession is possible this year, if it does happen, I doubt it will be severe, and so-called soft landing versus a hard landing. And right now, Chairman Powell's announcement that in December, that he was, basically putting a kibosh on any future hikes. There's a lot to indicate that we don't think that's going to be much likely that we'll have a big recession. So he's mindful of that. And right now, unemployment rate as of December was 3.7%. Okay, so the current economic environment for 2024, and inflation is trending down, as we just mentioned, but not finished. The consumer price index is 3.4% year over year. However, the Fed inflation target remains 2%. The Federal Reserve announced a rate hike pause, as I mentioned, in December. The consensus is not really a consensus, but we have heard, really bullish people saying, oh, there are going to be 10 cuts this year, and that'll get the economy booming. We think 3 is probably most likely, and even then, it would only be 0.75%. But that'll only happen if inflation data supports it. And then finally, unemployment is the other major factor. And as I mentioned, in the 80s, pundits said that full employment was under 5. But don't forget that unemployment tends to be a lagging indicator. So we wouldn't necessarily see the immediate impacts in unemployment figures until a few months later. All right, so now what's the impact on the markets? So 2023 was the recession year that never was. I mean, in beginning a year ago today, everybody was talking about recession, and soft landing, hard landing. That never happened. The Fed's 5.5% rate hikes, the largest in history, hit the U.S. regional banks hard, but artificial intelligence and strong consumption masked more widespread negative impact. Don't forget, our economy is 70% based on consumption, and that remains strong all the way through the holiday. So, that's part of the reason why the recession never really hit. There are basically two main outlooks in 2024, and we're getting all of these, the 2024 year projections from every management and brokerage firm out there. The bear market one says, well, the lagged effects of higher rates will hurt the economy, and a recession fears will reignite and possibly have a recession. As I mentioned, I don't think a recession would be very likely. The second is the bull market, where the economy reaccelerates and drives inflation higher, preventing the Fed from making the cuts so many anticipate. But I think one of the things that really set us up for scratching our heads was the dominance of the so-called Magnificent Seven, which left a lot disappointed with their portfolio results. So this is the seven. It's actually 8 individual companies, but it's 7. It's Facebook, Apple, Amazon, Netflix. Google has 2 share classes, so even though it's 2 share classes, it's really one company. Microsoft, Nvidia, and Tesla. And what this chart shows is what in orange is the impact and the performance of the Magnificent Seven, or 8. The dark line represents the actual performance of the S&P, and the blue area represents the performance of the next 492 stocks on the S&P 500. So that's a real problem, because when you think about it, you tell me what the correlation looks like to you. I mean, it's almost identical. The entire S&P now really is kind of acting like a tech sector fund. That wasn't always the case. I mean, if you go back 20 years, it was different companies like Exxon and IBM and other companies. Microsoft was still part of it, which were the dominant parts. But these 8 stocks represent about 30% of the index and 75 to 80% of the return. And that kind of an imbalance is a problem. This is exactly why, and I've done another workshop or video about this, why we don't pay attention to the S&P as an index, because it doesn't represent the stock market. It represents an overweighted focus right now on tech stocks. So, what are the other issues with that? Is this is the year-over-year revenue growth on the S&P, and as you can see, the trend line is consistently down. So, back in 2003, the revenue growth numbers were off the charts. Now they're much more muted, and that diminishing revenue growth correlates with a deceleration in price increases, or another way of saying, you can't count on the price to go up as much. You also have increased single stock risk if you just buy the 8. And at some point they need to revert to the mean. And then finally, the other thing to bear in mind is, because those things are so dominant and such a big part of the S&P, that if we have a market correction or a bear market, and there are net redemptions out of mutual funds, the first thing those managers are going to sell are their most profitable positions, which are these companies, and they're really going to get smacked. We actually saw that in 2022. So the fact is that you probably have good exposure. I know our clients have individual stocks in these individual stocks, but they also have diversification, and I think that's part of the thing. So Magnificent Seven distorted the move from growth to value, and may well continue until it stopped. This is our beliefs for 2024. Value and small cap value and SMID cap value will outperform growth over the next several years. SMID stands for small to mid cap value. There are better valuations outside of mega cap stocks. I mean, what I'm basically saying here is obviously these things are not as highly valued from a price earnings ratio than these. So there's better value here than up here. So that makes sense. International equities will outperform the US over the next several years. Japan in particular looks like the best international country to own. China has a massive amount of problems with their real estate issue, as well as the fact that I just can't trust the data coming out of China because it's a managed economy, and I don't believe a lot of the data that comes out. Europe has been down for a while and will continue. However, I still think there's an argument for diversification in Europe. Inflation could remain higher, so exposure to commodities and natural resources will help mitigate the effects. And then finally, I would just be skeptical about anybody that says that the market ride this year will be smooth. I think the election will create more volatility, and I don't expect this year to be a smooth ride. All right, this is a chart that shows you growth returns by decade versus inflation. And so right now, inflation is at 3.4%. And as you can see, right now, you might expect growth to slightly underperform the benchmark. There were some times back in the 30s when inflation was 2%, but the growth was off the charts. But as you can see, most of the decades are down here when inflation is higher. So the higher you get in inflation, the lower performance and growth, which is that. Now, contrast that to value. As you can see here, that value will probably at 3.4% will outperform. Most of the value decades are higher when inflation is higher. And I think, when you consider the last 30 years, inflation's been 2%, but I'm expecting, and a lot of people are expecting, the normal equilibrium for inflation somewhere between 3 and 3.5, which is what it was when in 1983 when I got into the business. Then I think that's the way to consider it. In terms of market sectors, we like consumer discretionary stocks. Why? Because as prices come down in inflation, people have higher disposable income. Therefore, they can afford, Coach products and other things that are more high-end in scale. The energy sector has strong fundamentals, high earnings, and free cash flow. Underweight on telecom, consumer staples, and healthcare, all challenged by higher capital costs, low free cash flow, and negative sentiment. Financials are becoming attractive, but there may be more downside before it turns around, especially regional banks. And I think the reason there is that COVID has changed the way people work. People are working from home. We're seeing massive vacancies in offices, office space in places like New York, which is right now 36%. I think Seattle is 30%. And so what happens when those commercial loans come due and they have to refinance? I mean, if you've got a 36% vacancy rate in a 100-story building, that means there are 36 floors that are empty. And what are you going to do? And I think what is likely is that you'll come back to the bank, but the bank will say, well, yeah, we can't, you're not 96% occupied, so your rate's going to go from 4 to 8 if they can actually get it refinanced at all. Your other alternative is to go to a private equity firm, and they'll be happy to lend you all the money, but then they're going to say, number one, we want a piece. And number two, if you default, we're taking the building. And you may see, and we're starting to hear stories of companies literally coming in and just throwing the keys at the bank saying it's yours. So I think the real estate market, especially in office, is really looking challenging. And so while my fundamental contrarian genes, which means, if the last thing you should do is look at, for example, financials, we start looking at financials and find the best companies, I still think there's more downside, but it's going to be more in the regional banks, less in the money center banks. And then finally, precious metals, copper, and other industrial materials look very good. So 5 keys to investing in 2024. Elections come and go, but results last a lifetime. We've already described the fact that election uncertainty, which does equal higher volatility, is great for patient investors because you use that downside to say what's on sale and how can I improve my portfolio, but stay in it for the long term. Do not make your decisions on, oh my gosh, Donald Trump or Joe Biden gets elected. Cash may not be as attractive as you think. There is a cost to being on the sidelines. Now, for a long time, cash, money markets, CDs were worthless. Now you can get 4 or 5% on a 1 year. The problem is if you buy that and you lock yourself in on 1 or a 2 year basis, and then rates drop as the Fed cuts rates and the market re-rationalizes on the interest rate curve, then you're going to wonder why you locked yourself in and didn't go further out, like 3 to 7 years. So number 3, innovation is alive and well, but diversification matters. Artificial intelligence, the mega tech stocks, the Magnificent Seven, ChatGPT, and NVIDIA have led to a technocentric market. And what's more important is to make sure you have diversification. Where? Into value, small cap value, international, all the things that we've mentioned. Finally, the comeback story in bonds may just be getting started. Typically at the end of a Fed tightening cycle, which is what we had in December of this year, it's been a good time for bonds. And then finally, there's always reasons not to invest, but markets are resilient. The key is time in the market, not timing the market. Okay, well, that wraps up my brief outlook on 2024 and a touch on elections. We welcome you to go to our website and go to our Learn page, where you may find other written video and audio blogs of interest, and hopefully to make your ride smoother and contribute to your sleep and digestion, and hopefully have your money do for you what it needs to do, which is to help you live the life you've imagined. Okay, thanks a lot for tuning in, and have a great day.